Hey, welcome back. Continuing our education on derivatives. What I'm using currently is actually a subscription based extension of Zerodha, which is sensible. In that, I'm using Strategy Builder to show you the P&L and the payoff for futures. I'm using this more in coaching options and futures for you. Uh, Whatever free features are there, you may go and explore this if you have a Zerodha account or many other brokers are offering sensible. But otherwise, it's a monthly subscription. It's about 1,300 rupees for a pro version, or a light version is about 600 rupees or so. But I'm sure that this is worth it. Let me tell you, first let me show you what exactly, if I get into 29th October, today, the 29th October contract, if I buy, what exactly is the payoff? This diagram is easy to learn and understand. Now, as we saw earlier, we know what's margin required. We already know that the margin required is about 1.44 lakhs. And this is where exactly currently it is trading at 11,751. This is where at this price I have no loss, no profit, or rather I just lose about 543, 44 rupees. Now, whatever is based on my view, if my view is, market is going to go up by 2%, let's say it's going to go up by 1% or 2%, which is approximately about, 11,980, then I end up making 11,631 as my profits. Otherwise, if I'm buying a naked future, we know that the profits are unlimited, losses are also unlimited. Now, what happens instead of that from the current level, like even if it falls, whatever is, it falls by about 0.5%, or wherever I keep my stop loss, it's about 11,700. Then I lose about 4,369. With each point, I lose about 75 rupees. That's a lot size. Now, this is how the payoff is all going to be. Now, as we know currently, the price, wherever it is trading currently, like wherever it is trading, let me see. Okay, this is where exactly it is. Okay, 11,756. And uh, let's look at this. The price remains there itself because of the premium, whatever premium currently attached. The loss actually with the time, with about 13 days to go for expiry, with each day it's increasing. This is because of the premium which is attached. If thinking that, currently it closes at this price, currently the spot is 11,756, and whatever we have bought is at 11,764. Okay, this is how the payoff diagram looks as of now for futures. Now, whether I buy, with every moment in price, either you make or you lose money. If it's downside, you lose money. If it's an upside, you gain. You gain the same. Now, based on your projection, where the market is likely to go from the current levels, it's going to go up about 1% up. Then you know that this is the kind of money you would make. If it's going to go down by about 1% or 1.5%, this is the money you would lose. Now, where to keep your stop loss? It all depends on this. Now, learning derivatives alone or futures alone is not complete unless you know how to place an option also. So we will be learning option, and then we will be placing artists along with options. Hey, okay, welcome back to options. Here in this screen, what I'm showing you is actually this is sensible screen. In the sensible, you have your broker also. Sometimes many of the brokers are giving sensible as an extension. When you have sensible, if your broker has given, in that I'm actually I've got into analyze data, and in that option chain. This option chain, in one screen, you'll be able to see the various strike prices at which the currently market is trading. As you know, Nifty today, as I'm talking, is currently at about 11,750. But let us watch the various strike price which is trading around that. 11,750 is exactly, it's at the money. As you know that, both in this, to the left hand side I have calls, on the right hand side I have put. Now, what all strike prices available, various strike price available is mentioned here. What is it trading? We know the price at which these strike prices are trading. Then I also know the open interest. What is the open interest? And change in most interestingly, change in open interest. As you can see here, suddenly there is actually some, there is a good amount of open interest here. What is the change? It's about 2%. Now, all of a sudden, I can see here there is a 56% increase in the open interest. So similarly, you can see there is a reduction in open interest or increase in open interest or any change in open interest from the previous day. You'll be able to see that. Apart from that, what price is that particular strike price? Like 11,700, call is currently priced at 203 rupees, whereas put is priced at 143 rupees. This is expiring on 29th October. This is the contract as we are watching. I think we're watching 29th October. Yes, it's here. So these are the various details. What is the IV? It's at 19 currently, and this is how it looks like. This is how the overall. This is the average IV. Implied volatility, as we can see. So currently this is the implied volatility, and then in fact this is a very good tool. Now what does this icon indicate? Whatever we are seeing here, this icon indicates there is no liquidity. It is not, there is no enough liquidity is what this icon indicates. Otherwise, as you can see here clearly, these are the various strike price available, and this is how all the puts are on this side, as you can see from 11,700 and going up. All these puts, there's a lot of open interest, and again the calls about 11,000. What should I say? About 11,600 onwards, up to about 12,000. There are a lot of calls. So this is how it looks like as of now. This is about the various strike price. So the one big difference here is what you do, you actually take a bet on a particular strike price. Like I take a bet on 11,700 or 11,800 or 750. Any of the strike price I choose, and whatever is the premium, that is the only thing which I pay. If I'm buying the call, my obligation is only to the extent of the premium which I have paid. If I have written or if I have sold that option strike price, then my obligation is actually I would have received the premium, but I'm open to the whatever risk, unlimited risk, or whatever is the scope of that option. Okay. Now, what I'm going to share with you is actually in this within the sensible in analyzed data, I'm explaining you the open interest, how the open interest keeps changing, how the open interest, it's a dynamic thing. Every time the market opens at 9:15 and closes by 3:30, you have the market is very dynamic. At that stage, how exactly this option is building up, the option, whether there's a lot of calls that is building up or whether it is the put that is building up, is what we see here. Now, I have an option here. As you can see, I can check either the Nifty weekly option or the monthly option, which is expiring on 29th. I have a choice to see that. Also, it is available for weekly Bank Nifty as well as monthly. Now, how does it stand basically right now? Right now, what does it indicate? The color in green is actually the put open interest. The color in red is actually the call open interest. As you can see that here, any graph which is below these lines are the positions which are winding up. These are the positions currently, whatever is the open interest, as you can see here. Now, when I look at the 29th November, there are more puts than the call. What does it mean actually? We have already learned what it means. If there are more calls, means there are more writing of the call, which means the experts are not believing that it is unlikely to go below 11,700. This is the view as of now for 29th October. Like, market is unlikely to breach this mark of 11,700, which means it's offering as a great support. Currently, as we know that it is trading at about 11,760, but there is a huge support right now created at 11,700. And the next only is actually at 12,100. 12,100, right now, there is a resistance at that level. As we can, let us go and see what is the call change. There's only about 0.6 million of calls that have changed, whereas its a number of puts is about 1.4 million. That is evident here. So as of now, this is where it stands. Now let us look at the historical option chain. Now this is looking at the option chain. This is where it gives the PCR. As you know that any PCR put call ratio, it is the ratio between the number of puts versus number of calls. Now, as you know, what do you mean by more number of calls? Which means where the trader is betting that market is unlikely to cross that level. The writer who is issuing the insurance, he's betting that the market will not cross that level if you're striking the or if you're writing the call. But if you're writing the put, means you're actually issuing an insurance saying that the market is unlikely to go below that particular level. As you can see here, there is a high put accumulation at 11,500, and there is a huge call accumulation at 12,000, which means the market is going to be range bound between 11,500 to 12,000. These are the major levels as of now. And as you can see, how many calls totally? Currently about 26.2 million. At the same time, the puts is about 37 million. The ratio is 1.4. This, in a way, indicates that the trend is bullish. Typically, when the markets are tumbling, falling, then how does it look? As you could see that yesterday there was about as you could see that there was a major fall in the market. This is how exactly it looked. I'm just going back to about October 12th. I'm just going back a few dates and seeing how exactly the markets were building up. As you could see that definitely there were more puts than calls. And then this is where we exactly stand today. Okay. This graph also indicates exactly the movement of these are the various indicators, indication we are getting. But this is about the market movement, the Nifty movement. This is the PCR movement, put call ratio movement, as you can see here. And with changing open interest. This can be analyzed for weekly or it can be analyzed for monthly. Similarly, it can be analyzed for Bank Nifty. As we clearly told that PCR study can only be done for these two indices as of now, and very few stocks, not more than 7 or 8 or 10 stocks at the most, whatever trading in the National Stock Exchange. Apart from that, there is not much or a substantial volume to justify that. Okay, this is how on a weekly, if I'm looking at a 22nd October expiry, this is how it looks like. The put call ratio is about 0.8, as you can see. And let us see what exactly is happening. I hope we are able to get a picture here where I'm seeing the weekly put call ratio. Let's analyze it right from 9th. The put call ratio was 12. From 12, we saw about 0.9. And then, markets were weak, then 1, and then 0.5. That's where I think we saw market really crunched. And then that's about 2.5% market came down. And then today we are seeing at 0.8, it's still weak, as we can see that, there's not much of strength in the market. This is how it looks like as of now. Okay, that's about the put call ratio. As I've already told you that this is not a complete study by itself. This is part of the study. This is not a comprehensive or a complete study. Or just based on this, you cannot be taking long position or short position. But knowing this will help you to take right kind of decision. Now I'm actually sharing something interesting with you. This is called Screener. This gives a lot of data. This gives you a lot of data. The most important, what I watch here is actually here. What I really look at is the IV percentile, the implied volatility percentile. Now, what does it mean actually? Now, here I'm actually, what should I say? I'm selecting it based on the highest number or the lowest number. Now, this percentile is about, it talks about in the last 100 days, this is the highest in the this is the 85th day. This is highest for the last 85 days. This is what it means in the last 100 days. This number is highest in the last 85 days. Now, this is how, like, which stock is it? Like, it is Coforge, Dr. Reddy, Tech Mahindra. What happens when the implied volatility is high? The expectation of the stock movement is not much. Sometimes, we see that, in the IV percentile is about 90, 95, 96. The stock will not be so much volatile, and not much of movement is expected out of it. Only when, if you are expecting a highly, if you are expecting a big movement in the stock, then the IV percentile has to be low, as you know. Now that is where you actually, what you do is actually you select these kind of stocks like Bandhan Bank or India Bulls, finance, and then check their chart to see that, if there is a, where exactly they stand. Now let's take an example. I would like to, go ahead and take this example of Bandhan Bank. Let me open this chart and see what exactly is happening with Bandhan Bank. Now, okay, I'll just take some of the thing out. Okay, now it makes the study easy. Now, as you can see that, it is poised. Right now we are watching a 5 minutes chart. As we are watching a 5 minutes chart, right now it is poised well. As you can see that, it is above 7 and 21 period moving average, as well as it's above the super trend. The stock is looking good in a 5 minutes chart. I just put it to 15 minutes chart, 15 minutes chart. Now this is where, it has exactly, right now it has crossed over, and definitely, that, if there is substantial volume above 313, this stocks look good. There is a lot of potential movement. Now let me go back to the screener and see where the IV percentile is very high. I would like to just look at Dr. Reddy's. Probably I would like to look at Dr. Reddy's here. Now, what's happening with Dr. Reddy? Let's see. Again, I'm going to clear this space. Okay. And as you can see here, there's already a moment, and then currently it is sideways. Currently, after a big moment, it's on a sideways movement. Even in a 5 minutes chart, it's on a sideways movement. Let me check with a 15 minutes chart. Okay. Not much. It's actually showing a slight, as I can say that, that there is a reversal, but it's not a confirmed up move. There is no confirmed down move also. It is more or less going to move in a sideways. This is how, we actually study IV, implied volatility percentile. As you notice here, we have Nifty and Back Nifty here. As you can see here, there's a Max Pain concept of Max Pain. Max Pain is where it is said that, the writers or the big players in the market who have actually who are undertaking this, these positions, huge positions. This is the point. Below this, they would lose money. So this is where, this is where the maximum support lies. So currently it is 11,600 for Nifty, and this is a 23,000 for Bank Nifty. Similarly, for all these stocks, is currently the ACC is trading at, as you can see, it's 1553, but the maximum price is 1460, which means below this, even the pain point, there will be pain in the market, which means the large players or the institutions or the operators will lose money if it trades below this. This is what it indicates. As you can see, for Ambuja, it is about 230. For Apollo Hospital, it's about 2140. This is only a concept. This is not a proven theory or anything. This is only a concept, as it is clearly told. It's arrived. It's mathematically arrived. Basically, it's based on the various positions. It's mathematically arrived at this point. So this is how it looks. As you can see here, there is a possibility that, Bajaj Financial Service, as you can see, the pain point is 6,000, but currently it is trading even about 27 rupees below that. This is how it is, which means it is likely to close above that possibility. I'm not saying this. It's a possible that, it's possible that it's likely to close above that. So when you watch this, whatever we are watching here currently, whatever we are watching the screener, for me, the one takeaway is, to watch the implied volatility percentile. This is what it indicates in the last 100 days. This level, where does it fall? This is the highest in the last 47 days. In the last 47 days for Nifty, it's the highest. Similarly, I can actually sort it based on the lowest to highest. As you can see that, for these stocks, it's below 20. Some of the times, you get with an IVP of about 8, 10, 20, or whatever in a single digit. Those stocks you can look at. There's a huge volatility, possibility of a huge movement in the near term. Whereas, when you look at invested percentile, so implied volatility percentile, excess of 90, more or less, the steam is gone, of that, of the rally. and possibly it is going to remain sideways or not much of a movement left in that. Again, this is one of the concepts. This is not a complete study by itself. This is one of the concepts which you can also watch. Suppose you're watching a stock, you can actually check this investor implied volatility percentile, and then you can actually take a call also. Another interesting screen I wanted to share with you is, this screen actually gives you a ready-made search. Rather, here you have an option. Not many option is there. It is in terms of, you either have an hourly chart or a daily chart, weekly chart or monthly. What does it show? It shows candles and moving averages. Based on the moving averages, whether it is bullish or bearish. Now, this is some of the stock search you can do. How does it give? It basically gives you that there is a bearish piercing which has happened on a daily chart. This is what they would like to give, or a bearish engulf. And some of the stocks which are trading around 100-day as well as the 50-day moving average, also it gives you an indication based on which you can actually make your decision. So this is also available on an hourly chart. So when you look at actually an hourly chart now, Ambuja Cement, there is a shooting star, which it says. Let's check on an hourly chart what exactly it has to say. So let's get into an hourly chart, and let me make way for okay. Now, this is what they're trying to hint at. A shooting star which has formed. So this is how you can actually maybe use the screen for some stock selection, whether you are looking at an hourly or you're looking at a daily chart. This will give you some output based on which you can actually study the same. So this screen can be used to actually check various stocks, whether on hourly or daily chart, where exactly is it trading around 100-day moving average, or a 100 period or a 50 period moving average, or if there is any particular indication, it is just showing. So this is how maybe this screening can also be used, or the technical signals can be used. So I'll be introducing you to various strategies, various other things as we move on. I'll be introducing to various things, even the virtual trade, strategy builder, and strategy wizard, how it works. Also, I'll be sharing with you.